If you enjoyed this audiobook, please consider liking, sharing, and subscribing to the channel. Sharing it with your friends and family helps spread knowledge. And when we help others grow, we grow too. Thank you so much for listening. Let's dive into the audiobook. Chapter 1. Meet Your Credit Score. Part 1. What is a credit score, really? When Chase Bank executive Jamie Dimon testified before Congress in 2012 about credit decisions, he revealed something striking. We make thousands of lending decisions every hour based primarily on 3 numbers. Those numbers represent your financial reputation compressed into a single score that determines whether you qualify for a mortgage, car loan, or even an apartment rental. Think of your credit score as your financial GPA. Just as colleges use grades to assess academic performance, lenders use credit scores to evaluate financial responsibility. This 3-digit number, ranging from 300 to 850, tells a compressed story about how you've managed money and debt throughout your adult life. When Suze Orman conducted her famous credit score experiment in 2018, testing identical loan applications with different scores, she discovered that a borrower with a 760 score received a 4.2% interest rate, while someone with a 640 score faced 6.8% for the same loan. Your credit score emerges from data collected by 3 major credit bureaus: Experian, Equifax, and TransUnion. These companies gather information about your financial behavior from banks, credit card companies, and other lenders. 2 primary scoring models dominate the landscape: FICO, created by the Fair Isaac Corporation and used by 90% of top lenders, and VantageScore, developed jointly by the 3 bureaus. The scoring algorithms analyze 5 key areas of your financial life. Payment history carries the heaviest weight, accounting for 35% of your score. This reflects whether you pay bills on time and how often you've been late. Credit utilization follows at 30%, measuring how much of your available credit you actually use. Length of credit history contributes 15%, rewarding those who maintain accounts over time. Credit mix adds 10%, considering the variety of credit types you manage successfully. New credit inquiries round out the final 10%, tracking how frequently you apply for new credit accounts. Not everyone starts with a credit score. Young adults typically develop their first score after 6 months of credit activity, whether through a student credit card, becoming an authorized user on a parent's account, or taking out a student loan. The Federal Trade Commission's 2020 study found that 26 million Americans have no credit score at all, often called credit invisible, while another 19 million have insufficient credit history to generate reliable scores. Your score fluctuates based on monthly reporting cycles. When Capital One reports your balance and payment information to the bureaus, your score may change within days. This dynamic nature means improvement is always possible, but it also means negative changes can happen quickly if you miss payments or max out credit cards. Understanding these fundamentals helps demystify what feels like an arbitrary number. Your credit score represents mathematical analysis of your financial behavior patterns, not a judgment of your character or worth as a person. Part 2. The characters that shape your score. When Sarah Martinez first discovered that her credit card company had reported a late payment despite her automatic payment being set up, she learned something crucial about credit scores that most people never realize. Your credit score isn't just one number calculated by mysterious forces. It's the result of 5 distinct factors working together, like characters in an ongoing financial drama, each playing a specific role in determining whether lenders see you as trustworthy or risky. Payment history commands the leading role in this financial story, accounting for 35% of your credit score calculation. This character tells lenders whether you consistently pay your bills on time and how often you stumbled. Every payment you make, whether it's your credit card minimum, car loan, or mortgage, gets reported to credit bureaus monthly. Even one payment that's 30 days late can drop your score by 60 to 100 points, as happened to James Chen when his student loan autopay failed during a bank switch. The second most powerful character is credit utilization, wielding 30% influence over your score. This factor measures how much of your available credit you're actually using across all your cards. Financial experts consistently recommend keeping this ratio below 30%. But the real magic happens when you stay under 10%. Consider Maria Rodriguez, who raised her score from 640 to 720 in 6 months simply by paying down her credit card balances from 85% utilization to 8%, without opening new accounts or changing her payment habits. Length of credit history acts as the wise elder, contributing 15% to your score calculation. This character rewards patience and stability, measuring both the age of your oldest account and the average age of all your accounts. When David Kim was tempted to close his first credit card with its $39 annual fee, he discovered that keeping this 7-year-old account open was worth far more than the fee. Closing it would have reduced his average account age and potentially lowered his score. Credit mix takes on a supporting role at 10%, representing the variety of credit types you manage successfully. Lenders prefer seeing that you can handle different kinds of credit responsibly. Revolving credit, like credit cards, installment loans like auto financing, and mortgages. However, this doesn't mean you should take on debt you don't need just to improve your mix. New credit inquiries round out the cast at the final 10%. Each time you apply for new credit, lenders perform what's called a hard inquiry that can temporarily lower your score by a few points. The impact typically fades within a year, but multiple applications in a short period can signal financial distress to lenders. These 5 factors work in concert, creating your unique credit profile. Understanding each character's role helps you make strategic decisions that strengthen your financial story over time. Part 3. Why your score matters to you. When Sarah walked into her dream apartment in downtown Seattle, she had no idea her 3-digit credit score would determine whether she'd call it home. Despite having a steady income and first month's rent ready, her 580 credit score meant an immediate rejection. The landlord explained that in today's competitive rental market, they only consider applicants with scores above 650. Sarah's credit score had just cost her the perfect home. Your credit score functions as your financial passport in modern America. This number determines not just whether you qualify for loans, but the price you'll pay for nearly every major purchase in your life. Consider 2 neighbors buying identical $300,000 homes. Jennifer, with a 760 credit score, qualifies for a 3.2% mortgage rate. Her monthly payment is $1,296. Down the street, Michael's 620 score means he pays 4.8% interest, resulting in monthly payments of $1,574. Over 30 years, Michael pays $100,080 more for the same house simply because of his lower score. Auto loans follow similar patterns. Experience 2023 data shows that borrowers with excellent credit, 781 to 850, received average auto loan rates of 4.9%, while those with poor credit, 300 to 579, faced rates averaging 14.8%. For a $25,000 car loan over 5 years, this difference costs nearly $7,500 in additional interest. The rental market has become particularly score-sensitive. TransUnion research reveals that 90% of landlords now check credit scores during application processes. Many property management companies use automatic screening systems that reject applications below certain thresholds, typically 620 to 650 for competitive markets. Even utility companies like Con Edison in New York require security deposits from customers with low credit scores, sometimes demanding hundreds of dollars up front. Employment screening represents another growing area where credit scores matter. Wells Fargo, Bank of America, and thousands of smaller financial firms review credit reports for positions involving money handling. Poor credit can disqualify candidates from jobs in banking, accounting, and even retail management roles at companies like Target and Home Depot. Insurance premiums also reflect credit health. In states where it's legal, insurers like State Farm and Allstate use credit-based insurance scores to set rates. Florida Insurance Commissioner data shows that drivers with excellent credit pay up to 50% less for auto insurance than those with poor credit, even with identical driving records. The psychological impact proves equally significant. Lisa Chen, a financial counselor in San Francisco, notes that clients with good credit report less stress when making major purchases. They approach car dealerships and mortgage brokers with confidence, knowing they'll qualify for competitive rates. Conversely, those with poor credit often avoid applying for necessary financing, limiting their opportunities and perpetuating financial struggles. Premium credit cards offer another advantage. Chase Sapphire Reserve cardholders with excellent credit enjoy benefits like airport lounge access, travel insurance, and valuable reward points. Meanwhile, those with damaged credit may only qualify for secured cards with annual fees and no rewards, missing opportunities to earn hundreds or thousands of dollars in benefits annually. Your credit score essentially determines your financial options and costs. Understanding its impact helps you prioritize credit health as a fundamental component of your overall financial strategy. Part 4. Common myths about credit scores. When Sarah's mortgage application was rejected despite her steady $75,000 salary, she learned a harsh truth. Widely believed credit myths had quietly sabotaged her financial standing for years. Research from the Consumer Financial Protection Bureau reveals that 79% of Americans hold at least one major misconception about credit scoring, often leading to decisions that actively damage the very scores they're trying to improve. The most destructive myth suggests that closing old credit cards boosts your score. Sarah had followed this advice religiously, shutting down her first credit card after college and later closing 2 department store cards she rarely used. What she didn't realize was that each closure reduced her total available credit, while her balances remained the same, dramatically increasing her credit utilization ratio. When TransUnion analyzed her report, her utilization had jumped from a healthy 15% to a damaging 47% simply because she had less available credit to work with. Credit expert Anthony Davenport consistently encounters clients who believe checking their own credit reports hurts their scores. This misconception keeps people in the dark about their own financial standing. The truth involves understanding inquiry types. When you check your own report through authorized channels like annualcreditreport.com, it creates a soft inquiry that appears only to you and has zero impact on your score. Hard inquiries occur when lenders check your credit for lending decisions, and even these typically lower scores by just a few points temporarily. Perhaps the most expensive myth claims you must carry credit card balances to build credit. Dave Ramsey's Financial Peace University has documented countless cases where people pay unnecessary interest believing this falsehood. Credit scoring models actually reward consistent, full balance payments. When you carry balances, you're simply paying interest without any credit score benefit, while simultaneously increasing your utilization ratio. The collections myth proves equally costly. Many people believe paying off collections immediately removes them from credit reports, leading to rushed payments without strategic negotiation. In reality, paid collections often remain on reports for up to 7 years. Smart consumers first attempt pay-for-delete agreements, where creditors agree to remove the entry entirely in exchange for payment. Income confusion runs rampant among credit newcomers. Your $100,000 salary doesn't directly influence your credit score calculation. FICO and VantageScore models focus entirely on credit behavior patterns, not earnings. However, higher income does affect your ability to manage debt payments, indirectly supporting better credit habits. Age-related myths create unnecessary limitations. College students often think they're too young to build credit, while seniors assume damaged credit can't be repaired. Credit expert Scott Hilton documents successful credit building among 18-year-olds using secured cards and authorized user strategies, while also helping clients in their 70s rebuild scores after financial setbacks. The all debt is bad mentality overlooks how scoring models actually evaluate different debt types. Mortgage payments and student loans often help establish positive payment history, while high credit card balances signal potential risk to lenders. Understanding these realities helps you make informed decisions that actually support your credit goals rather than undermining them through well-intentioned but misguided actions. Chapter 2: The Credit Score Journey. Part 1: How your credit story begins. When Marcus graduated college in 2018 with zero credit history, banks treated him like a financial ghost. Despite landing a solid engineering job, his loan applications were rejected because lenders had no evidence he could manage credit responsibly. This scenario affects millions of young adults annually. Yet building your first credit history requires surprisingly modest steps that compound into significant financial power over time. Your credit journey begins with a single account, but choosing wisely makes all the difference. The most accessible starting points include secured credit cards, student credit cards, or becoming an authorized user on a family member's account. Capital One and Discover offer student cards with no annual fees and reasonable terms for beginners, while secured cards from companies like Secured MasterCard require a deposit but guarantee approval for most applicants. The secured card route proved transformative for Maria Santos, who started with a $300 secured card in 2019. She used it exclusively for gas purchases, paying the full balance monthly. Within 8 months, her credit score reached 720, qualifying her for an unsecured card with better terms. The key was consistent, small purchases that stayed well below her credit limit. Starting small prevents overwhelming debt while establishing positive payment patterns. Many newcomers make the mistake of applying for multiple cards simultaneously, which triggers numerous hard inquiries and signals desperation to lenders. Instead, focus on one account for 6 months before considering additional credit products. Time becomes your greatest asset in credit building. Credit scoring models heavily weight the length of your oldest account, which explains why financial experts recommend keeping your first card indefinitely. A 20-year-old account carries more scoring power than multiple newer accounts, making that first choice particularly important for long-term credit health. Common fears about starting often center on potential debt accumulation or making costly mistakes. These concerns are valid but manageable through simple safeguards. Set up automatic payments for at least the minimum amount to avoid late fees, and consider using your credit card for one recurring bill like Netflix or Spotify. This creates consistent usage without overspending temptation. Your first credit score typically appears after 3 to 6 months of account activity. During this period, patience becomes crucial as your credit file develops. Expect modest credit limits initially, often between $200 to $500, which gradually increase as you demonstrate responsible usage. The authorized user strategy offers another pathway, particularly effective when added to accounts with long, positive histories. When Jake's grandmother added him as an authorized user on her 15-year-old account with perfect payment history, his credit score jumped 100 points within 2 months. However, choose this option carefully, since any negative activity on the primary account affects your credit too. Research potential cards thoroughly before applying. Focus on products without annual fees rather than attractive rewards programs, which typically require excellent credit for approval. Read terms carefully, understanding penalty fees and interest rates that apply if you carry balances. Building credit from zero requires consistent, small actions rather than dramatic moves. Each on-time payment, each month of low utilization, and each positive account adds another brick to your credit foundation. Start today with whatever option fits your situation best, knowing that your future financial opportunities depend on the credit story you begin writing now. Part 2: The Good Habits That Build Trust. When financial expert Anthony Davenport analyzed thousands of credit profiles, he discovered something remarkable. People with scores above 800 didn't just make good decisions occasionally. They had transformed credit management into automatic habits. These high scorers weren't necessarily earning more money. They had simply mastered the daily routines that build unshakable trust with lenders. The foundation of excellent credit rests on one non-negotiable principle: every payment, every month, on time. Warren Buffett's business partner Charlie Munger once said that success comes from avoiding mistakes rather than hitting home runs. This wisdom applies perfectly to credit building. A single 30-day late payment can drop your score by 100 points and remain visible for 7 years, while consistent on-time payments gradually build an unassailable payment history. Setting up automatic payments eliminates the human error factor entirely. Bank of America reports that customers using AutoPay have payment success rates exceeding 99.8% compared to 87% for manual payments. Configure AutoPay for at least the minimum amount due, with calendar reminders set 3 days before due dates as backup protection. This dual system ensures you never miss payments even during busy periods or travel. Credit utilization presents another opportunity for daily excellence. While the commonly cited 30% rule provides basic guidance, credit expert Al Bingham's research shows that consumers with scores above 800 typically maintain utilization below 10%. American Express cardholders with perfect payment histories often keep their utilization under 5%, treating credit cards like debit cards by paying balances immediately after purchases. Consider Netflix co-founder Reed Hastings' approach to subscription management. He built systems that prevented any service interruption, knowing that consistency mattered more than optimization. Apply this mindset to credit by using cards for small, recurring expenses like streaming services or phone bills, then setting automatic payments to clear these charges monthly. This creates positive payment history without the temptation of overspending. Monthly credit monitoring should become as routine as checking your bank balance. Credit Karma reports that users who check their scores monthly catch errors 40% faster than those who check annually. Download apps from Credit Karma, Credit Sesame, or your bank's monitoring service, setting monthly calendar reminders to review reports and track progress. Keep old accounts open and occasionally active even after opening better cards. When Capital One customers close their oldest cards, their average credit history length drops by 18 months, directly impacting their scores. Make small purchases on older cards quarterly, perhaps a tank of gas or grocery trip, then pay the balance immediately. This maintains account activity without creating debt. During financial stress, communication becomes crucial. JPMorgan Chase data shows that customers who contact them before missing payments receive hardship options 78% of the time, compared to only 23% for those who call after delinquency. Proactive communication demonstrates responsibility and often results in temporary payment modifications that protect your credit standing. These habits compound over time, creating credit profiles that open doors to premium opportunities and favorable terms for decades. Part 3. What can hurt your score? Picture this. Sarah Rodriguez, a marketing professional from Phoenix, watched her credit score plummet 127 points in just 6 months during 2019. She wasn't careless with money, yet simple mistakes cascaded into credit catastrophe, costing her thousands in higher interest rates and nearly preventing her dream home purchase. Late payments create the most devastating credit damage. FICO research shows that a single 30-day late payment can drop excellent credit scores by 60 to 100 points, while those with average credit might lose 60 to 80 points. The impact varies based on your existing score, but the damage is immediate and lasting. These late marks remain on your credit report for 7 years, continuing to influence lending decisions long after you've corrected the behavior. Payment timing matters more than most people realize. Credit card companies typically report late payments to bureaus once they reach 30 days past due, not at the first missed payment. This creates a dangerous grace period where people assume they have more time. Wells Fargo data from 2020 revealed that customers who made payments between days 15 to 29 late often faced fees but avoided credit report damage, while those hitting day 30 experienced immediate score drops. Maxing out credit cards signals financial distress to lenders, regardless of your payment history. When utilization ratios exceed 30%, scores begin declining, but the damage accelerates dramatically above 50%. Credit expert Anthony Davenport documented cases where clients saw 40-point drops simply from utilization spikes, even when paying balances in full monthly. The scoring algorithms interpret high balances as risk indicators, suggesting you're relying too heavily on credit to maintain your lifestyle. Closing old credit accounts creates two simultaneous problems: reduced available credit and shortened credit history. When Jennifer Martinez closed her first credit card after 10 years to avoid annual fees, her score dropped 43 points within 2 months. The account had comprised 35% of her total available credit, instantly increasing her utilization ratio across remaining cards. Worse, losing her oldest account reduced her average account age, another key scoring factor. Multiple credit applications within short periods trigger score reductions through hard inquiries. Each application typically costs 5 to 10 points, but the damage compounds when lenders see desperate credit-seeking behavior. FICO penalizes multiple inquiries for different credit types within 14 to 45-day periods, assuming rate shopping versus credit desperation. However, 5 credit card applications in 3 months suggests financial stress, prompting larger score decreases. Collections, charge-offs, and defaults create severe long-term damage. Medical collections now carry less weight than other types, but unpaid credit obligations devastate scores for years. Charge-offs, where lenders write off unpaid debts, can drop scores 150-plus points and remain visible for 7 years. Even after paying charged-off debts, the negative marks persist, though updated status showing paid provides slight improvement. Co-signing exposes your credit to another person's financial decisions entirely. When Marcus Thompson co-signed his brother's auto loan in 2018, he assumed minimal risk given his brother's steady employment. 6 months later, job loss led to missed payments, damaging both their credit profiles equally. Co-signers bear full responsibility for debt obligations, with payment problems affecting both parties' credit reports identically. Life events create indirect credit damage through changed circumstances. Divorce often forces account closures and payment disruptions as couples separate finances. Medical emergencies generate unexpected expenses that can lead to missed payments or high credit utilization. Job loss creates income gaps that strain existing payment obligations. Identity theft represents perhaps the most insidious credit threat. Fraudulent accounts can appear without your knowledge, accumulating debt and missed payments that damage your score before discovery. Regular credit monitoring helps identify unauthorized activities quickly, but recovery requires extensive documentation and dispute processes that can take months to complete. Prevention requires vigilance across multiple fronts. Set up payment alerts well before due dates. Maintain utilization below 10% when possible, and resist closing old accounts unless absolutely necessary. Monitor credit reports monthly through free services and address discrepancies immediately before they compound into larger problems. Part 4. How to read your credit report like a pro. When Sarah Martinez opened her first credit report in 2019, she stared at 3 pages of cryptic codes and abbreviations that might as well have been written in ancient hieroglyphics. 2 years later, after learning to read these documents like a seasoned financial detective, she caught an erroneous late payment that would have cost her thousands in higher mortgage rates. This transformation from confusion to confidence represents exactly what every consumer needs to master. Your credit report functions like your financial report card, but unlike school transcripts, This document directly impacts your ability to buy a home, get a job, or secure favorable loan terms. The Federal Trade Commission reports that 1 in 5 consumers has an error on their credit report significant enough to affect their creditworthiness. Learning to read these reports isn't just helpful, it's financially essential. Start by understanding that credit reports contain 4 main sections. Personal information appears first, listing your name, addresses, social security number, and employment history. This section doesn't affect your score directly, but errors here can signal identity theft or data mix-ups that create bigger problems later. The account history section contains the meat of your credit story. Each account shows your payment history using simple codes. OK means on-time payments, while 30, 60, or 90 indicate days past due. Account status descriptions like current or closed by consumer tell you the current state of each account. Pay special attention to credit limits and current balances, as these numbers calculate your utilization ratios. Account type abbreviations initially seem confusing, but follow logical patterns. R indicates revolving credit like credit cards. I represents installment loans like car payments, and M shows mortgage accounts. The numbers following these letters range from 1, paid as agreed, to 9, charged off or sent to collections. The inquiry section splits between hard and soft pulls. Hard inquiries from credit applications remain visible for 2 years and can temporarily lower your score. Soft inquiries from background checks or pre-approved offers don't affect your score and may only be visible to you. Public records contain the most serious negative information: bankruptcies, tax liens, and civil judgments. Chapter 7 bankruptcies remain for 10 years, while Chapter 13 bankruptcies disappear after 7 years. Most other public records also fall off after 7 years. Anthony Davenport emphasizes checking all 3 major bureaus, Experian, Equifax, and TransUnion, because creditors don't always report to all 3. A missed payment might appear on Experian, but not Equifax, creating score discrepancies that could work for or against you, depending on which report a lender pulls. When reviewing your reports, look for common red flags: accounts you didn't open, payments marked late when you paid on time, wrong credit limits, or accounts that should have aged off but remain visible. These errors aren't rare. They're practically inevitable, given the massive volume of data these bureaus process monthly. The key to professional-level credit report reading lies in systematic review. Check personal information first, then scan account histories for unfamiliar entries. Verify payment histories match your records, and finally, review inquiries for unauthorized credit checks. This methodical approach transforms an overwhelming document into manageable, actionable information that protects your financial future. Chapter 3: Healing and Growing Your Score. Part 1: Fixing Bumps in the Road. When Sarah checked her credit report after her divorce, she discovered a 480 credit score buried under medical collections, missed mortgage payments, and 2 accounts she never opened. What seemed like financial devastation actually became her roadmap to recovery once she learned which battles to fight first. Your credit report tells a story, but not every chapter deserves equal attention. Start by categorizing your credit issues into 3 buckets: errors you can dispute immediately, legitimate debts you need to address strategically, and old issues that time will heal naturally. This triage approach prevents you from wasting energy on problems that will resolve themselves while missing opportunities for quick wins. The formal dispute process represents your most powerful tool for immediate improvement. When challenging inaccurate information, specificity wins over generic form letters. Instead of writing, "This account is not mine," provide concrete details like, "I was deployed overseas during the dates shown and have military records proving my location." Credit bureaus must investigate specific claims within 30 days, and they often side with consumers who provide compelling evidence. Collection agencies operate like businesses seeking profit. not revenge. This creates negotiation opportunities that many consumers never explore. Marcus Johnson, a credit counselor in Detroit, helped clients save thousands by understanding that collectors often purchase debts for pennies on the dollar. A $2,000 medical bill might have cost them $200, making a $600 settlement profitable for everyone involved. Pay-for-delete agreements remain controversial but effective when properly executed. Document everything in writing before sending payment. The phrase, "This payment constitutes full and complete satisfaction of the debt," with the understanding that the account will be deleted from all credit reports, protects you legally. However, not all collectors will agree to deletion, particularly if they service accounts for the original creditor rather than owning the debt outright. Student loan rehabilitation offers second chances that many borrowers never discover. After making 9 consecutive on-time payments under a rehabilitation program, the default status disappears entirely from your credit report. This differs from consolidation, which merely changes the loan servicer while keeping the default notation. Jennifer Martinez saw her credit score jump 150 points within 6 months of completing rehabilitation on her defaulted nursing school loans. Timing matters more than most people realize in credit repair. Recent negative items hurt scores more severely than older ones, making current accounts your priority. A 30-day late payment from last month damages your score more than a 3-year-old collection account. Focus your immediate attention on bringing current accounts into good standing before addressing historical issues. The statute of limitations on debt collection varies by state and debt type, typically ranging from 3 to 6 years. However, making any payment or even acknowledging the debt can restart this clock. Before paying old collections, research whether they can still legally pursue you through the courts. Sometimes the smartest strategy involves patience rather than payment. Credit repair requires endurance rather than speed. Most legitimate improvements take 30 to 120 days to appear on credit reports, with significant score increases often taking 6 months or more. Susan Williams watched her score climb from 520 to 720 over 18 months by systematically addressing issues in order of impact rather than trying to fix everything simultaneously. Part 2. Paying down debt without losing your mind. When Sarah Martinez stared at her credit card statement showing a minimum payment of $847 across 5 different cards, she felt the familiar weight of financial dread settling in her chest. Like millions of Americans carrying an average of $6,194 in credit card debt, she faced a choice that would determine her financial future for years to come. The decision between debt snowball and debt avalanche strategies often comes down to psychology rather than mathematics. Dave Ramsey's debt snowball method gained popularity because it works with human nature rather than against it. When Marcus Thompson paid off his smallest credit card with a $312 balance first, ignoring the fact that his personal loan carried a higher interest rate, something remarkable happened. The psychological boost from eliminating an entire payment gave him momentum to tackle larger debts. Within 2 years, he eliminated $34,000 in consumer debt using this approach. However, the debt avalanche method saves more money on paper. Financial planner Suze Orman advocates paying minimums on everything except the highest interest debt. A recent study by Harvard Business School showed that people using the avalanche method save an average of $854 in interest payments compared to the snowball approach. The catch? Only 67% of avalanche users stick with their plan compared to 84% of snowball followers. Your personality determines which method works best. Are you motivated by quick wins? Or do large interest payments keep you awake at night? Jennifer Walsh discovered her answer when she calculated that her 24.99% credit card was costing her $43 monthly in interest alone. That concrete number made the avalanche method feel urgent rather than abstract. Creating breathing room in your budget requires surgical precision, not starvation tactics. The 50-30-20 rule needs modification during debt payoff. Financial advisor Michelle Schroeder Gardner suggests the 50-20-30 split instead. 50% for needs, 20% for debt payoff, 30% for everything else, including minimum emergency savings. Never eliminate your emergency fund completely. Medical billing specialist Amy Nickerson learned this lesson when an $800 car repair forced her to use credit cards after she had redirected her entire emergency fund toward debt payments. Balance transfers can accelerate progress when used strategically. The key lies in the promotional period math. If you transfer $8,000 to a card with 0% interest for 18 months, you need to pay $445 monthly to eliminate the balance before promotional rates expire. Chase Slate Edge and Citi Simplicity offer some of the longest promotional periods, but read the fine print carefully. Marketing manager Tom Richardson thought he had 21 months to pay off his transferred balance, only to discover the promotional rate applied to transfers made within the first 60 days only. Side income specifically earmarked for debt creates faster progress without lifestyle sacrifice. Rachel Cruz documented families earning an extra $500 to $1,500 monthly through focused efforts. Weekend farmers market sales, freelance graphic design, or evening food delivery. The psychological separation matters. When all extra income flows directly to debt, you maintain your regular lifestyle while accelerating payoff timelines. Address spending triggers before they sabotage progress. Retail therapy, stress spending, and social pressure create the debt cycles that got you here initially. Track emotional spending patterns for 2 weeks. Do you spend more on Mondays? After difficult phone calls? During lunch breaks? This awareness prevents the cycle from restarting just as balances begin dropping. Every percentage point of credit utilization reduction potentially adds points to your credit score. As balances drop below 30%, then 10%, then 0%, you will see your score climb steadily upward, making every payment a double victory for your financial future. Part 3. When to ask for help and where to find it. When your credit repair efforts feel like pushing a boulder uphill alone, or when collection agencies ignore your dispute letters for the 3rd time, it might be time to call in reinforcements. The key lies in recognizing when your situation requires specialized knowledge that goes beyond basic DIY strategies. Rachel Martinez thought she could handle everything herself after discovering identity theft had destroyed her 720 credit score. 6 months later, after countless phone calls and disputed items that kept reappearing, she finally sought help from a nonprofit credit counseling agency. Within 3 months, a certified counselor had successfully removed fraudulent accounts that Rachel couldn't budge on her own. Sometimes professional expertise cuts through red tape faster than determination alone. Consider professional assistance when you face identity theft involving multiple fraudulent accounts, legal violations by creditors or collection agencies, or complex debt situations involving multiple creditors with varying statute of limitations. If you're dealing with mortgage issues, bankruptcy considerations, or persistent Fair Credit Reporting Act violations, specialized knowledge becomes invaluable. Nonprofit credit counseling agencies approved by HUD offer legitimate, affordable help. The National Foundation for Credit Counseling maintains a directory of certified agencies that provide budget counseling, debt management plans, and credit report reviews for minimal fees. These counselors receive extensive training and follow strict ethical guidelines, unlike many for-profit companies. Consumer law attorneys who specialize in credit reporting issues can be powerful allies when creditors violate federal laws. Attorney Leslie Tain has successfully sued collection agencies that continued reporting disputed debts without proper verification, resulting in both debt removal and monetary damages for clients. Many attorneys work on contingency for clear violations, meaning you pay nothing unless they win. Beware of credit repair companies demanding upfront fees or promising to remove accurate negative information. Legitimate companies cannot do anything you cannot do yourself, and federal law prohibits payment before services are completed. Red flags include guarantees about specific score increases, pressure to dispute accurate information, or advice to create a new credit identity using an employer identification number. The Consumer Financial Protection Bureau maintains a complaint database where you can file grievances against creditors or credit reporting agencies. State attorney general offices often mediate disputes and investigate predatory practices. These government resources cost nothing and carry significant weight with financial institutions. Sometimes bankruptcy provides the cleanest slate for overwhelming debt situations. Consumer bankruptcy attorney Steve Bucci explains that Chapter 7 bankruptcy can eliminate unsecured debts within 4 months, allowing faster rebuilding than years of minimum payments on impossible balances. Find qualified bankruptcy attorneys through local bar association referrals and always get free consultations before committing. The most effective help often comes from education rather than paying others to fix your problems. Federal Trade Commission resources, nonprofit financial education websites, and library books provide the knowledge needed to become your own advocate. When you understand credit scoring models, consumer protection laws, and negotiation strategies, you transform from victim to informed consumer who commands respect from creditors and collection agencies. Part 4. Keeping your score safe from identity theft. When Javelin Strategy and Research found that a new identity theft case emerges every 22 seconds in America, they confirmed what credit experts have long warned. Your carefully built credit score can vanish overnight through no fault of your own. The damage extends far beyond stolen money, creating a financial nightmare that can take years to resolve. Consider Lisa Martinez, a Denver nurse who discovered her identity theft only when applying for a mortgage. Fraudsters had opened 17 credit accounts in her name over 8 months, running up $43,000 in debt across multiple states. Her credit score plummeted from 720 to 480, and the mortgage denial was just the beginning. Even after proving the fraud, cleaning up the mess took 14 months of documentation, disputes, and persistent follow-up calls. Identity thieves target credit files because the damage multiplies quickly. Each fraudulent account they open can generate months of missed payments, maxed-out credit lines, and collection accounts. The Fair Isaac Corporation estimates that identity theft can drop credit scores by 50 to 200 points within the first few months, depending on the scope of fraudulent activity. Prevention requires vigilance across multiple fronts. Shred all documents containing personal information, including pre-approved credit offers and medical bills. Create strong, unique passwords for financial accounts, and avoid conducting financial business on public Wi-Fi networks. These basic steps block many common theft methods, but determined criminals require stronger defenses. Credit monitoring services provide crucial early warning systems. Free options through credit card companies typically monitor one credit bureau, while comprehensive paid services like LifeLock or Identity Guard watch all 3 bureaus plus public records and dark web activity. The key lies in response speed rather than prevention alone. Early detection can limit damage to a few accounts rather than the systematic destruction Lisa experienced. Credit freezes offer maximum protection by preventing new account openings entirely. Unlike fraud alerts that merely require additional verification, freezes block all credit inquiries unless you specifically lift the restriction. This strategy works particularly well for people not actively seeking new credit. The process requires separate requests to all 3 major credit bureaus, but the protection justifies the effort. When identity theft occurs, immediate action determines recovery success. File police reports within 24 hours to establish official documentation. Contact each fraudulent creditor directly, not just through credit bureaus. Request written confirmation that accounts will be closed and marked as fraudulent. Document every conversation with names, dates, and reference numbers. The Identity Theft and Assumption Deterrence Act provides specific consumer rights during recovery. Creditors must stop collection activities on disputed fraudulent accounts while investigations proceed. They cannot report negative information about accounts you've identified as fraudulent until completing their review process. Recovery timelines vary significantly based on theft complexity. Simple credit card fraud might resolve within 3 months, while mortgage fraud or synthetic identity theft can require 2 years or more. The Federal Trade Commission reports that full credit restoration averages 18 months for comprehensive identity theft cases. Children's credit requires special attention since thieves often target minors specifically because the fraud goes undetected for years. Consider freezing children's credit files early and monitor elderly family members who frequently fall victim to sophisticated phone and email scams targeting their established credit histories. Chapter 4: Your Credit Future Made Bright. Part 1: Building Credit for Big Dreams. Sarah Martinez stared at her credit report in disbelief. The 580 score that had haunted her for years suddenly showed 740. 2 years of disciplined payments and smart credit management had transformed more than numbers on a screen. Within 6 months, she purchased her first home with a 3.2% mortgage rate, launched her consulting business with a $25,000 business line of credit, and finally felt financially free. Your credit score represents far more than a 3-digit number. It serves as your financial passport, opening doors to opportunities that shape your entire life trajectory. When Anthony Davenport analyzed thousands of credit transformations in his research, he discovered that people with excellent credit scores didn't just save money on loans. They accessed completely different life paths unavailable to those with poor credit. Consider homeownership, the foundation of generational wealth building. Borrowers with credit scores above 760 qualify for the best mortgage rates, often saving $200 to $400 monthly compared to those with scores around 620. Over a 30-year mortgage, this difference amounts to $72,000 to $144,000 in interest savings. These borrowers also qualify for premium loan programs like VA loans with 0 down payment or FHA loans with just 3.5% down, making homeownership accessible years earlier than traditional financing requires. Business ownership becomes remarkably more achievable with strong credit. Mark Cuban started his first company partly because his excellent credit allowed him to secure equipment financing at competitive rates. Today's entrepreneurs with scores above 700 access business credit cards with $50,000 plus limits, equipment loans at prime rates, and SBA-backed financing that can fund ambitious ventures. Poor credit forces business owners toward expensive alternative lending, sometimes paying 25 to 40% interest rates that strangle growth potential. Major purchases transform from financial stress into strategic decisions. Excellent credit holders finance vehicles at 2 to 4% interest rates, while poor credit borrowers pay 15 to 25%. On a $30,000 car loan, this difference costs an additional $200 plus monthly. The same pattern applies to boats, RVs, and recreational purchases that enhance quality of life. Educational opportunities expand dramatically with strong credit. Parents with excellent scores access private student loans at competitive rates when federal aid falls short. They can also leverage home equity for education expenses at much lower rates than high-interest education loans. Geographic flexibility increases substantially when landlords and utility companies view you as a preferred customer. Excellent credit holders rent premium apartments without additional deposits and establish utilities instantly during relocations. Poor credit often requires substantial deposits and cosigners, limiting career mobility. Family relationships benefit when strong credit enables joint financial goals. Couples with excellent credit qualify for larger mortgages, while those with damaged credit may face rejection or require one spouse to apply a loan. Parents with good credit can responsibly co-sign their children's first credit accounts, launching the next generation toward financial success. Emergency preparedness improves through access to home equity lines of credit or personal loans at reasonable rates. When Steve Bucci studied financial resilience, he found that people with excellent credit weathered emergencies without devastating their long-term financial health. Every positive credit action you take today compounds into future opportunities. Your current discipline creates tomorrow's possibilities, building a foundation that supports not just your dreams, but your family's aspirations for generations ahead. Part 2. How to use credit wisely every day. When Maria switched from constantly checking her credit card balance to checking it just twice weekly, her credit score jumped 40 points in 6 months. The difference wasn't what she tracked, but how she used credit as a daily financial tool rather than an emergency lifeline. Smart credit usage starts with treating your cards like debit cards with superpowers. Chase Sapphire cardholders who put monthly recurring expenses like utilities and subscriptions on autopay build consistent payment history while earning rewards. The key lies in spending only what you already have budgeted, then paying the full balance every month without exception. Credit utilization timing can dramatically impact your scores. Jennifer paid her credit card balance to 0 3 days before her statement closing date each month. This simple timing adjustment showed 2% utilization instead of 15%, boosting her score by 35 points. Most people don't realize that card companies report your balance on the statement date, not your payment due date. Choosing new credit products requires looking beyond flashy sign-up bonuses. When Dave Ramsey analyzed credit card marketing tactics, he found that cards with the best long-term value often have modest initial offers but superior ongoing benefits. A card with 1.5% cash back on everything beats a card offering 50,000 bonus points if you'll never use those rewards effectively. Life changes demand credit strategy adjustments. During divorce proceedings, Susan immediately removed her ex-husband as an authorized user and requested credit limit increases on her individual accounts. This preserved her creditworthiness when joint accounts eventually closed. Similarly, recent retirees should maintain at least one active credit card to preserve their credit history, even on fixed incomes. Travel rewards optimization requires balancing earning potential with utilization ratios. Frequent travelers often spread expenses across multiple cards to keep individual utilization below 10%, while maximizing category bonuses. American Express cardholders who use cards for all travel expenses but pay balances weekly maintain low utilization while earning maximum points. Good credit extends beyond lending benefits. Insurance companies like State Farm offer discounts up to 20% for customers with excellent credit scores. Rental car companies provide better rates and skip deposits for high-score customers. Even utility companies waive security deposits when your credit demonstrates reliability. Managing multiple credit accounts successfully requires systematic approaches. Financial advisor Suze Orman recommends setting up automatic minimum payments on all cards, then manually paying full balances on your primary cards. This prevents missed payments while keeping less used accounts active. Strategic promotional financing can accelerate wealth building when used carefully. Home improvement purchases on 0% APR cards allow you to spread costs while building equity immediately. The crucial rule: only use promotional financing when you can pay the full balance before the promotional rate expires, avoiding devastating retroactive interest charges. Credit becomes your financial foundation when managed wisely every day, creating opportunities and savings that compound throughout your lifetime. Part 3. Monitoring your progress and staying motivated. When Sarah Martinez checked her credit score in January 2019, she saw 543 staring back at her. 18 months later, that number had climbed to 721. The secret wasn't magic or expensive credit repair services. It was consistent monitoring and celebrating small wins along the way. Creating realistic goals transforms overwhelming credit repair into manageable steps. Start by determining your current baseline through all 3 credit bureaus, since scores can vary by 30 to 50 points between agencies. credit expert Anthony Davenport recommends setting 90-day mini goals rather than fixating on perfect scores. If you're at 580, aim for 620 in 3 months, not 750 by next year. Most credit cards now provide free monthly FICO scores, making monitoring effortless. Capital One's Credit Tracker and Chase's Credit Journey offer detailed breakdowns showing exactly which factors boost or hurt your score. For comprehensive monitoring, services like Credit Karma provide weekly updates and alert you to changes immediately. Score fluctuations of 10 to 20 points monthly are completely normal, even with perfect payment behavior. Credit utilization updates, new accounts aging, and seasonal spending patterns all create natural movement. Al Bingham, author of The Road to 850, emphasizes tracking trends over individual months. 3 consecutive months of improvement matters more than 1 month's dip. Document your journey systematically. Create a simple spreadsheet tracking monthly scores, credit card balances, and new positive activities like successful disputes or paid-off accounts. Popular apps like Credit Sesame automatically track this data, sending motivational notifications when improvements occur. Accountability accelerates progress dramatically. Leslie Tane, financial attorney and author, suggests sharing goals with trusted family members who check in monthly. Online communities like Reddit's credit forums provide support and celebrate victories with people facing similar challenges. Seeing others succeed with identical strategies reinforces that your efforts will pay off. Plateau periods test patience most severely. When scores stagnate for 2 to 3 months despite good habits, remember that positive payment history continues building silently. Each on-time payment strengthens your foundation even without immediate score increases. During these periods, focus on maintaining discipline rather than chasing quick fixes. Celebrate milestones appropriately without sabotaging progress. When reaching 650, treat yourself to a nice dinner, not a shopping spree that increases balances. Liz Pulliam Weston recommends non-financial rewards like weekend trips or experiences that don't impact credit utilization. Improved credit creates natural motivation through expanding opportunities. Better scores qualify you for premium credit cards with rewards, lower insurance premiums, and apartment rentals in desirable areas. These tangible benefits reinforce why maintaining good habits matters long-term. Share knowledge with others beginning their credit journey. Teaching friends about payment timing or dispute processes deepens your own understanding while creating positive accountability relationships. This cycle of helping others keeps you engaged with credit education and reinforces successful habits. Transform monitoring from stressful obligation into rewarding routine by viewing each improvement as proof that your system works. Part 4. The Credit Score Life Cycle. When you think your credit journey ends with reaching a good score, you're actually just beginning. Credit management evolves dramatically throughout life, requiring different strategies at 25 versus 55 versus 75. Understanding this evolution helps you make smarter decisions today while preparing for tomorrow's challenges. Your 20s represent the foundation years. During this stage, focus on establishing credit history through starter cards and small loans. Many young adults make the mistake of avoiding credit entirely, thinking it's safer. Maria Rodriguez learned this lesson when she applied for her first apartment at 24 with zero credit history. Despite excellent income and savings, landlords rejected her applications because she had no credit footprint. She quickly opened a secured credit card and student credit card, making small purchases and paying balances in full monthly. Within 18 months, her score climbed from non-existent to 720. The 30s typically introduce larger financial obligations. Mortgages, car loans, and possibly growing families require more sophisticated credit management. This stage demands balancing higher balances while maintaining low utilization ratios. John Mitchell navigated this period by securing a mortgage with a 750 credit score, then strategically managing multiple accounts without letting his score slip. He automated all payments and used only 30% of available credit limits across all cards. Middle age brings new considerations around helping family members build credit. Many parents add teenage children as authorized users or co-sign first credit accounts. This stage requires teaching good habits while protecting your own credit health. Financial planner Susan Chen recommends setting strict parameters when helping adult children, including written agreements about payment responsibilities and regular monitoring of joint accounts. Later life presents unique challenges often overlooked in credit education. Fixed incomes can make maintaining multiple accounts more difficult. Account closures due to inactivity become more common as spending patterns change. Additionally, surviving spouses sometimes discover they've relied too heavily on deceased partners' credit accounts. Estate planning attorney Robert Davis regularly sees widows struggling with credit after losing access to joint accounts they rarely used independently. Major life events require immediate strategy adjustments. Divorce necessitates separating joint accounts and establishing independent credit. Job loss might require negotiating payment plans to protect credit health. Retirement often means adjusting credit limits and account types to match reduced income. Different life goals demand varying credit approaches. First-time homebuyers need pristine payment history and low debt-to-income ratios. Business owners require both personal and business credit development. Frequent travelers benefit from rewards optimization strategies that might not suit homebodies. Economic changes continuously reshape credit management. New products like Buy Now, Pay Later services affect traditional scoring models. Credit score requirements for major purchases shift with market conditions. Staying educated about these changes ensures your strategies remain effective. The most successful credit managers view it as a lifelong skill, requiring continuous adaptation. Habits developed early create flexibility for future opportunities. Poor habits established young can create obstacles lasting decades. Your credit journey continues evolving, but strong fundamentals learned now provide the foundation for navigating whatever changes life brings.